Global macro indicators are currently signaling a synchronized bullish trend. Diplomatic progress between the US and Iran has eased shipping concerns, cooling oil prices, while IT equities climb following a series of strong sector upgrades. These tailwinds usually transition directly into the Gift Nifty, the primary lead indicator for the Indian market. Instead, the Gift Nifty is indicating a 50-point gap down. The local market is moving in direct opposition to the global trend. Today marks the monthly Nifty expiry. On these days, the typical relationship between macro news and price action is superseded by the mechanics of the options market. To determine the day's trajectory, we must calculate the specific pressure exerted by institutional derivative positioning. Institutional analysts approach these sessions through a top-down first principles framework to map the likely trading range. First, filtering geopolitical shifts. Second, quantifying institutional cash flows.
And finally, analyzing the options chain. This identifies the expiry pin, a state where aggressive hedging by market makers traps the index at a specific strike price. In this environment, fundamental news acts as background noise, while the expiry pin dictates the price. We can resolve the Gift Nifty gap down by plotting these conflicting fundamental and technical forces on a single matrix. The geopolitical landscape has shifted as diplomatic talks between the US and Iran mitigate fears of maritime disruption. Brent crude has consequently fallen to approximately $85.05 per barrel. For the Indian market, lower energy costs generally serve as a bullish catalyst. Sentiment in the IT sector has also improved following a positive upgrade from Jefferies. This led to gains in the US ADRs of Infosys and Wipro, providing a clear lead for domestic tech stocks. However, these gains are countered by institutional caution ahead of major US earnings from Microsoft, Apple, Amazon, and Meta. The upcoming Federal Reserve interest rate decision is further limiting global risk appetite. Domestically, the banking sector faces localized friction, specifically within HDFC Bank. An internal investigation into deposit pricing led to penalties for senior executives. Though no fraud was found, the news creates a neutral to negative outlook for the heavyweight. While oil and IT provide a lift, the combination of global earnings caution and banking sector friction creates a net neutral macro backdrop that does not explain the 50-point drop. The explanation appears when we look at hard institutional liquidity data. Domestic institutional investors injected 2,329 crore into the cash market, providing a steady base. But foreign institutional investors were aggressive net sellers, offloading 1,688 crore. This foreign selling creates significant drag on the index. FII cash distribution often has a magnified impact on the Gift Nifty's valuation as a leading indicator.
This selling is a direct expression of the global hesitation regarding the Fed and US tech earnings. The sustained FII selling is the primary force pulling the index lower, overriding the geopolitical optimism seen elsewhere. To find where the index will likely settle, we must examine the structure of the Nifty options chain. The Nifty recently recovered to 24,000. At this strike, we see nearly matched open interest for puts and calls, with put interest slightly higher, establishing a thin margin of support. Lower strikes show significant put concentrations at 23,950 and 23,900. This concentration creates a hard floor, as put writers will defend these levels to prevent the index from sliding further. We see a different structure when looking at the resistance levels above the current price. At 24,100 and above, call open interest is exceptionally high compared to the put interest at those same strikes. This heavy call writing creates an overhead supply barrier that makes a rally beyond 24,100 difficult to sustain. This creates a defined boundary for the session, effectively capping the index between 23,900 and 24,100. Moving the market beyond this 200-point corridor would require a surge in cash buying that is currently absent due to FAII selling. The index is effectively pinned between the put support at 23,900 and the call resistance at 24,100. A breakout from this range would require a spike in volatility, but the India VIX is signaling the opposite. The VIX fell by 9.76% yesterday, a significant collapse in the market's expectation of risk. This drop leads to aggressive premium erosion. For an expiry day, this environment favors option sellers and reduces the profitability of directional bets for option buyers.
Without a sudden expansion of volatility, price momentum typically stalls, becoming trapped entirely within the established open interest boundaries. The collapse in the VIX reinforces the range dictated by the options chain, making a major breakout unlikely. The 50-point gap down on the GIFT Nifty follows the logic of sustained FII selling despite the improved global energy and tech landscape. This opening move places the index directly within the high-volume 24,000 straddle. The session is bounded by a 23,900 floor and a 24,100 ceiling. Any move toward these extremes will be met by institutional sellers defending their respective strike prices. In this environment, fundamental-based momentum strategies are likely to face significant resistance. Technical methodologies focused on range-bound price action and theta decay are better suited to these conditions. Although the broad range is capped, the price action within that 200-point corridor will likely remain volatile as the monthly contracts approach settlement. On a monthly expiry, the final settlement price is determined by the positioning of the options market.